Hello, my fellow gold and silver stackers. Welcome back to Gold Rush Reporter, your go-to channel for no-nonsense insights on gold and silver markets. Before we dive in, make sure you hit that like button, subscribe, and turn on notifications, because what we're talking about today is going to be a game changer for anyone holding precious metals. And if you're stacking silver, stay tuned, because I've got some important updates about supply, deliveries, and what $100 silver really means. We're starting with a bold prediction from Andy Schectman, a veteran in the precious metals world. He says $100 silver isn't the top, it's just the trigger. That's right. We're looking at a rally so massive it could disrupt the financial system itself. For decades, silver was dismissed as gold's volatile cousin. It was suppressed, overlooked, and underestimated. But that era is over. Institutional money is flowing in, deliveries are breaking records, and supply constraints are forcing prices higher. This isn't hype. This is reality. What's different now is the deliverability factor. Back in 2019 and early 2020, nobody stood for delivery. Investors and banks didn't want physical silver. Today, the situation has changed dramatically. Sovereign nations, family offices, and big institutional players are standing for delivery consistently. They are taking physical metal, draining the market slowly and strategically, forcing a shift in control from paper silver to real silver. This is a deliberate accumulation process, and it's accelerating. We're also seeing leverage plays being neutralized. The CME Group recently raised margin requirements on COMEX silver contracts. That's a coordinated effort to shake out leverage traders, but it doesn't affect the big players. Sovereign nations, large industrial buyers, and institutional accounts pay cash. They aren't worried about margin calls. When smaller traders are forced to sell, the big players buy up the metal. That's why silver's identity is changing before our eyes. It's not just an investment or hedge anymore. It's becoming a strategic asset critical for national security and modern technology. Deliveries are another eye-opener. In the first few days of January 2026, millions of ounces of silver were delivered, numbers that were unprecedented in modern history. 18 million ounces of silver and 425,000 ounces of gold moved in just a few days. Who has that kind of money? Only the most well-informed, connected institutions. The big players are prioritizing physical possession over speculation, and that's the kind of demand that can't be ignored. Industrial demand is surging too. Silver is essential in solar panels, EVs, AI data centers, and 5G infrastructure. There's no substitute at the scale the modern economy needs. These buyers are price inelastic. Whether silver is $50, $85, or $150, they have to secure it. Combine that with geopolitical factors like China's export restrictions, and you have a supply-demand imbalance that is only getting more severe. And for those of you who are stacking, here's a quick engagement reminder. We've just launched a Silver News Daily Telegram with a 10-ounce silver giveaway. To enter, be subscribed, comment on 3 separate videos, and join the group. Once we reach 500 active members, one lucky stacker will get 10 ounces shipped directly to them. This is a great way to stay connected with the market and the community in real time. As we continue, let's dive into the heart of what's driving this silver surge. One of the biggest factors is the physical deliveries on COMEX and other major exchanges. In the first few days of January 2026 alone, millions of ounces of silver moved, with 18 million ounces delivered in just 4 days. Gold also saw over 400,000 ounces delivered. These numbers aren't random. They reflect deliberate positioning by some of the largest, most informed players in the market. The big question for most investors is, who has the money and resources to take delivery at this scale? We're talking sovereign nations, large industrial buyers, and institutional investors. These are not casual traders. They understand the real value of silver, and are actively converting paper holdings into physical metal. And unlike small retail traders, they're not worried about price swings or margin calls. They're paying cash and taking possession. That's a critical distinction. This activity has a cascading effect on the market. When large players stand for delivery, it drains the COMEX and LBMA vaults, reducing available inventory. Smaller traders and funds that rely on paper silver are suddenly at a disadvantage. The paper markets, where there can be hundreds of ounces traded for every physical ounce available, are being exposed. Arbitrage opportunities shrink because physical metal is being prioritized over contracts. It's also a story of institutional strategy and timing. For years, some banks and funds quietly accumulated silver, moving little by little to avoid market shocks. This slow accumulation was deliberate. They knew that if they bought too quickly, prices could spike prematurely and trigger system-wide instability. But now, the pace is accelerating, and the metal is starting to leave public markets at a visible rate. This is exactly what we've seen over the past 13 months. Record deliveries, growing industrial demand, and decreasing inventories. Supply is another concern. Mining production cannot keep up with global consumption. Over the last 6 years, the world has consumed more silver than was mined, creating a structural deficit. Recycling and scrap silver can help, but it's not enough. Refiners are seeing longer delivery times, and even industrial buyers are facing shortages. Companies in solar, EV, and electronic sectors are now paying premiums to secure silver. This is not a short-term imbalance. It's a structural issue that will intensify as demand grows. And let's not ignore geopolitics. China, a major supplier of refined silver, recently implemented export restrictions. This isn't about controlling price, it's about controlling supply. By limiting exports, China has introduced a new level of scarcity into the global market. Western refiners and buyers now face a tight supply chain at a time when demand is peaking. The combination of industrial demand, government accumulation, and geopolitical restrictions is creating a perfect storm for silver prices to move higher. Margins on the COMEX have also been raised recently. While this may sound technical, it has real-world implications. Higher margin requirements are designed to reduce leverage speculation, but they also shake out smaller players. Meanwhile, big players like JP Morgan and Citibank are absorbing massive deliveries, reinforcing their long positions while others are forced to sell. This reinforces the point. The market is being dominated by informed, well-capitalized players who understand that physical silver is the real prize. In short, what we're seeing is a market transition from paper to physical dominance, with structural demand outpacing supply. Silver is no longer a secondary, undervalued asset. It's becoming critical for industry, national security, and global wealth preservation. Prices may move violently in the short term, but the underlying trend is clear. The world is scrambling for physical silver, and the rally has only just begun. Now that we've established the scale of deliveries and the dominance of big players in silver, let's talk about why industrial demand is pushing silver higher and why $100 an ounce is just the beginning. Silver isn't just a precious metal anymore. It's a critical industrial component, and its scarcity is becoming more obvious every day. Take solar panels, for example. The world is in the middle of a solar revolution. TOPCon solar cells, the next generation panels, use significantly more silver than older models. Manufacturers like Panasonic, First Solar, and Tesla's energy division are scrambling to secure enough silver to meet production goals. There's no substitute. Copper and aluminum can't replicate silver's conductivity, reflectivity, and efficiency. The rise of renewable energy infrastructure has created a massive ongoing industrial demand for silver, and that demand is only going up. Then there's electric vehicles. EVs. Every EV contains more silver than a traditional combustion engine vehicle, because silver is used in batteries, wiring, and electrical contacts. As governments around the world push for EV adoption and subsidize green technology, automakers are competing to secure silver for production. Supply is limited, which creates price inelasticity. They will pay whatever it costs to get the metal. Unlike retail buyers, these are institutional and industrial players, and their demand can move markets on a global scale. AI and digital infrastructure are also driving demand. Data centers, 5G towers, and advanced computing systems all require silver for conductivity and thermal performance. With the AI boom and the digital economy expanding rapidly, silver's role in modern technology is more essential than ever. This isn't speculative demand. It's actual physical consumption that cannot be replaced by another metal. Every ounce that goes into tech is an ounce that won't return to the market. This rising industrial demand is colliding with structural supply shortages. Mining production has not kept pace with consumption for years. New mine projects are slow to come online due to environmental regulations, high costs, and geopolitical risks. Recycling helps, but it can't fill the gap. Refineries are stretched, and delivery times are increasing. The result? Physical silver is disappearing from the market faster than ever, and the gap between available supply and demand is widening. Geopolitical moves are amplifying this trend. China's recent export restrictions on refined silver have effectively cut a large portion of global supply from circulation. Western refiners and industrial buyers now face scarcity at the exact time demand is peaking. Sovereign nations, aware of silver's strategic importance, are quietly accumulating for national security. What was once considered a secondary asset is now a national security priority, creating competition at the highest levels. Meanwhile, the COMEX margin hikes are shaking out smaller traders. Retail investors who rely on leverage are being forced to sell, while big players like JP Citi, and sovereign accounts are taking delivery with cash. This highlights a market hierarchy shift. Those with deep pockets and direct access to physical metal now control the narrative, and the paper market is increasingly secondary. All of this explains why $100 silver isn't the ceiling, it's the trigger point. Once industrial and institutional demand intersects with limited supply, the market enters a phase of rapid repricing. Prices won't just rise, volatility will spike as the market tries to balance demand with scarce inventory. Retail investors watching charts might panic at swings, but the long-term trend is driven by fundamental scarcity, industrial necessity, and strategic accumulation. In short, silver's identity is changing. It's no longer just a hedge against inflation or a store of value. It's a strategic, industrial, and geopolitical metal, indispensable to modern technology and energy. Anyone watching deliveries, refinery activity, and industrial orders can see that the next stage of this rally is structural, not speculative. Now that we've covered industrial demand and scarcity, let's dig into who is actually controlling silver right now and why this matters for every stacker. Understanding the players behind the scenes is key to seeing where prices are headed and why $100 an ounce is just the beginning. First, we need to talk about the big banks: JP Citi, Deutsche Bank, and others. These are not casual traders. They're handling millions of ounces of silver, both in physical and paper form. Over the last year, we've seen something unprecedented. Banks that were historically net short on silver are now net long, standing for massive deliveries rather than relying on paper positions. This is a fundamental shift in the market. It signals that the people with the deepest pockets are betting on physical metal, not just contracts. Take the January 2026 COMEX deliveries as an example. In the first 4 days alone, JP Morgan took over 2 million ounces of silver for client accounts, Citi took over 2 million for their own account, and Deutsche Bank delivered millions in response. These are transactions of billions of dollars, executed by institutions that have full visibility into global demand and supply. Retail traders can't compete with that scale. The message is clear. Physical silver is becoming concentrated in the hands of a few well-informed, well-capitalized entities. Next, let's discuss sovereign and strategic accumulation. Countries like China and Russia are quietly buying silver for national security reasons. Silver is now on the critical minerals list, and for good reason. It's essential for defense, communications, AI, EVs, and renewable energy. Governments aren't buying silver to speculate. They're stockpiling it to secure technology and industrial infrastructure. This is the kind of demand that is price insensitive. They will pay whatever it takes to get the ounces they need, and that drives scarcity even further. The paper market versus physical market dynamic is critical here. For decades, the paper market has dominated the perception of silver prices, with multiple paper ounces existing for every physical ounce. But what happens when delivery is demanded? The paper contracts lose meaning, and the metal has to change hands physically. That's what we're seeing now, a shift from paper speculation to physical ownership. And it's happening right when industrial and sovereign demand is peaking. Small and retail traders face margin calls during spikes in volatility. CME margin increases in January forced many leveraged positions to liquidate. That dropped the price temporarily, but the big players, cash-rich and strategically positioned, absorb those ounces instantly. This creates a cycle where volatility favors those with physical holdings and deep pockets, while paper traders are squeezed out. The lesson is simple. If you're long on paper silver, you are vulnerable. If you hold physical, you are in control. Add to that the geopolitical dimension. China's export restrictions have effectively cut off a major supply channel. The West is scrambling to secure silver, and industrial buyers like solar and EV manufacturers are competing with banks and sovereigns. This isn't a short-term shortage. It's a structural deficit that will persist until new supply projects come online, which could take years. Now, what does this mean for you as a stacker? First, you need to focus on physical silver. Bars, rounds, coins. These are assets you can hold, not promises on a screen. Second, understand that volatility will increase dramatically as these dynamics play out. There will be sharp price swings as big players absorb distressed selling and margins are adjusted. But the long-term trend is undeniable. Silver is transitioning from a suppressed commodity to a strategic, high-demand asset. Finally, keep an eye on delivery reports, COMEX notices, and refinery supply. Every month, these numbers reveal who is really positioning for the next wave. The big banks, sovereign wealth funds, and strategic industrial players are writing the rules now. For retail investors, understanding this hierarchy is essential to making informed decisions. You're no longer just buying a hedge, you're entering a market where physical control equals leverage and knowledge equals profit. As we conclude our deep dive into silver, it's time to focus on what you, the stacker, should do right now. The silver market is no longer just a commodity play. It's a strategic asset class, influenced by industrial demand, sovereign accumulation, and bank positioning. Understanding these forces will separate those who preserve wealth from those who watch opportunities slip away. First, let's talk physical silver strategy. Forget paper contracts, ETFs, or derivative exposure unless you fully understand the risk. The market is shifting toward physical delivery, and if you don't have actual ounces, you're vulnerable. Coins, bars, rounds, these are your tools. Prioritize metals that are easily transferable and recognized globally, such as standard 1-ounce rounds, kilo bars, or government-minted coins. These are liquid, hold value, and are immediately accepted in any market scenario. Second, don't focus on the short-term price. Yes, volatility is extreme. Margins have been raised on COMEX, leverage positions liquidated, and prices have swung by double-digit amounts in a single day. That's expected. What matters is accumulation over time. Even if a pullback occurs, it's just another opportunity to acquire more ounces. Think in terms of kilograms or total ounces, not dollars per ounce. Physical accumulation is about positioning, not timing. Third, monitor delivery reports and supply chain signals. The COMEX, LBMA, and refinery updates provide a glimpse of the real demand. When millions of ounces move into vaults or refineries report longer delivery times, that's a signal of scarcity and institutional demand. Every month of strong deliveries reinforces that the market is shifting to physical first, leaving paper contracts secondary. Awareness of these movements gives you insight others simply don't. Fourth, consider long-term strategic positioning. Silver is now being classified as critical for national security, technology, and renewable energy. Governments, sovereign wealth funds, and industrial giants are stockpiling for reasons that go far beyond speculation. This is not a short-term bull run. It's a multi-year revaluation of the metal's importance. Stackers who understand this trend can ride a wave that isn't speculative. It's structural. Fifth, diversify within physical silver. Include bullion, industrial-grade silver where feasible, and collectible coins. Each has its role: bullion for liquidity, industrial silver for potential partnerships or hedging, and collectibles for scarcity premiums. This approach mitigates risk and ensures you benefit across different market conditions. Now, let's connect this to your actions today. Start by evaluating what you currently hold. Do you have ounces in secure, accessible locations? Are you prepared to take advantage of supply shortages or price spikes? Increase your holdings incrementally, focusing on quality over quantity initially, then scale as opportunities arise. Remember, scarcity is your friend. Every ounce you hold becomes more valuable as demand accelerates and supply tightens. Finally, stay informed. Follow COMEX reports, refinery delivery notices, and global geopolitical developments affecting silver. Channels like Gold Rush Reporter provide curated insights, but your research and awareness are what protect you from surprises. Understand the forces shaping prices, the players controlling supply, and the long-term trajectory of silver as a critical asset in a digital, industrial, and geopolitical world. Before we wrap up, a reminder to our Gold Rush Reporter community: engage, learn, and take action. If you haven't yet, subscribe to the channel, comment your silver stacking goals for 2026, and share your thoughts. Join the discussion with fellow stackers to sharpen your strategy and stay ahead of the curve. This is a pivotal moment in silver's history. The rules are changing, and the opportunities are massive, but only for those who understand the market, hold physical metal, and are prepared for volatility. $100 is not the top. It's just the beginning. Thank you for joining me today on Gold Rush Reporter. Keep stacking, stay informed, and we'll navigate this new silver era together. Until next time, secure your ounces, watch the deliveries, and never underestimate the power of physical silver in the right hands.